During overnight trading, JP Morgan quietly ran the whole silver market. What comes next is the question that the CFTC, the CME, the Federal Reserve, and every other major desk on Wall Street won't answer in public. Everything changes when you know the truth. The 750 million ounces of silver that JP Morgan owns are worth more than $40 billion, and the bank controls about 40% of the COMEX silver futures contracts. Now, this amount of institutional power is not common in the past before 2025. No single entity held more than 10 to 15% of any major commodity futures market. JP Morgan, on the other hand, held 40% of the entire COMEX silver futures market. This is from an institution that just a year ago had the largest paper short position in the history of the exchange, which was just used to keep silver prices low. The company had paid $922 million in 2020, which was the biggest fine the CFTC had ever given, with manipulating the silver market for 8 years. The company, whose former trader is Precious Metals, were told by the federal judge on December 22nd, 2025, that they could never again deal in the CFTC regulated markets. The institution that was found guilty of short selling in the market for 15 years has now become the largest owner of the long side. This is the happenings in the same market, on the same exchange, at the same COMEX vault, where the registered inventory has dropped 64% from its peak, all while being in charge of the whole world's largest silver ETF, SLV, and holding about 517 million ounces of silver for BlackRock shareholders in the charge of the SLV long position on the COMEX futures. The person who is thought to have the largest collection of real silver in history. And 3 months ago, traders in precious metals got the final CFTC order that banned them forever from market they helped shape for 10 years. What will happen next? In 8 minutes, I will show you. And the answer is not what the business press says, because JP Morgan went from being the biggest silver short to the biggest silver long in the world in the most important institution event in the modern history of this market. There are three possible scenarios for what comes next. Only one of them is good enough for the news for small buyers in silver. Now, if you're already a silver stacker, you definitely want to hang out for this. Now, if you already knew that JP Morgan changed the short to long before this movie showed up, one word that tells you you are not only looking at the price chart, but also the way institutions are placing their money for Let's Go. Now, before June and October 2025, JP Morgan went from having a huge 200 million ounce short position in paper silver contracts to have a net long position. This was a huge change in the way the physical silver market works, and removed the biggest long-term force that has been pushing prices down. People have said in the past that the bank aggression, short selling on platforms like COMEX, lowered silver prices by creating a huge supply of paper through the derivatives market, and in 15 years, they said, on what people in the silver market called the paper ceiling for that long. A long short position in futures produced the impression of unlimited supply, which drives down the paper price and stops the reality of unlimited supply from showing up in the price discovery process. The CFTC stated that it wasn't just a thought. A lot of traders at the JP Morgan Precious Metals and Treasuries trading desk, including the heads of both desks, placed hundreds of thousands of orders to buy or sell silver, gold, platinum, palladium futures contracts between 2008 and 2016. The goal was to cancel these orders before they were carried out, tricking market participants into carrying out orders that they didn't want to be carried out. The gold and silver, there were hundreds of thousands of orders, more than 8 years. The heads of both trade desks are among them. This wasn't a bad dealer. There was no future for them. The rules at the desk level. People said that this improving compliance would be a part of the fixing things that for the 2020 trading season. But they didn't know. They knew that it wouldn't work. This made it hard to see that compliance and control were still failing, even though the trades involved were worth billions of dollars. Silver business. In May 2024, the CFTC owned commissioner revealed that JP Morgan had broken the promise it made in 2020. The regulator had fined the bank $920 million for their original behavior and said that the bank's compliance architecture, the system that was supposed to stop the abuse from happening again, was not good enough. Then from June to October 2025, JP Morgan closed all of its short positions on 200 million ounces of paper and went out on a long position of about 750 million ounces of silver. Now, the group that lowered the price of silver for 15 years is now the group that wants it to go up as much as possible for business reasons. Let me now show you the exact structure of JP Morgan's power, because the only way to figure out what comes next is to understand all three levels of market dominance at the same time. Here's how JP Morgan's present situation is broken down. Holdings that are owned by COMEX and held by brokers based on aggregated exchange records. It's thought to be 196 million ounces. Take care of the SLV ETFs based on ETF holding records. It's thought to be 517 million ounces. Total exposure through the 713 million ounces to be exact. Note on data. These numbers show information from the whole market. To be sure of something, check the SEC SLV Daily Holdings Report through EDGAR, the CFTC Bank Participant Report from COMEX Positions, and the CME Warehouse Ledger. Empire on FX. There are three different control points. First, there is a proprietary stance bought 196 million ounces at COMEX in his own name, a position worth more than $16.4 billion at the moment. That makes money directly for every dollar that silver prices goes up. Second, there is a custodial job. 517 million ounces are kept safe for SLV owners in JP Morgan's vault, which means the JP Morgan has actual control over the metal, even though ETF holders legally own it. Third, the futures are in charge. Because JP Morgan's control so many futures markets, there is a feedback loop. It may cause paper prices to rise because it has a big long position in futures. which then forces real markets to align even if supply fundamentals don't allow it. JP Morgan Co., Dominant Parent, Tom Tiers P. Morgan, Tomco, Buzz, and Cryptoi P. Morgan, Tompo BM, sign dollar pressure. There is a feedback pressure that goes both ways. When JP Morgan was short, the feedback loop pushed down paper prices, which in turn pushes down paper physical premiums, which in turn pushes down the ETF inflows, which in turn lowers competition for the physical metal that JP Morgan's vault was stockpiling below market value. Now that JP Morgan is long, the feedback loop raises paper prices, which raises physical premiums and encourages ETF inflows, and raises down demand for the physical metal. Every dollar of upside helps JP Morgan's position. The process is the same. The only thing that has changed in the direction, and that direction changed as soon as the bank finishes setting up physically. Now, the important counter argument that Sprat Money, which is one of the most trusted precious metal study sites in North America, put out directly against JP Morgan's point of view. The new stories we're reading about JP Morgan ending their short position in silver are all just guesses. There is no way to know for sure if any of the bank is buying or selling. Any bank will never come out and say that what they are really doing. And the CFTC doesn't report individual positions. In this way, we can guess, speculate, make assumptions based on our past experiences, but we can't make claims that are true. CME's group, think about it. That's Bernie's honest opinion of JP Morgan's position reversal story, which was put out by the same company that thinks silver is in the most structural bullish situation it has ever been in. The CFTC report on bank involvement names specific banks. The estimated 713 million ounces is based on market figures. There isn't a single main source document that JP Morgan's name on a line that says 713 million ounces when Edgar SLV filings. The CFTC Bank Participant Report and the CME Warehouse Ledger data are all compared. The difference is very important. What this channel won't show a guess that hasn't been checked as a fact that has been checked as at all. Unless it's proven, it is considered a guess. It's the same across the number of different data companies, and it goes in the same way as the publicly available data delivery from January. Now, on January 7th, statistics showed that the JP Morgan was sending out 1,624 delivery notices for 99% of the 8.1 million ounces. What was strange about this, even with these sales, open interest rose by 431 contracts in January. Empire on FX, this is the main source data that has been documented. It's not a guess, not an attempt to rebuild. The official CME Group daily delivery notices reporter, which can be found on the CMEgroup.com, shows that the January 7th JP Morgan sent out 99% of the delivery notices while open interest rose at the same time. For a short time, you don't send out delivery notices. The person who is giving the metal sends out delivery notices for the person or businesses that own the bars and is selling them to the buyer. It was JP Morgan that delivered the most physical silver on January 7th with 99% of the session's total delivery amount. That's not just a guess, that is something from the CME group. Now, 3 specific outcomes that are possible because JP Morgan controls the market. Why only one of those outcomes is clearly good for small buyers? Watch how the government acts. How the CFTC handles concentrated holdings could change how the market works. If regulators set stricter limits, JP Morgan might have to get out of its stake, which could cause short-term volatility. USD coins, the result is 1. The CFTC stepped in. The CFTC that fined JP Morgan 920 million dollars for being short in this market is also the CFTC that sees 40% of COMEX futures money sitting in JP Morgan's long position. Position limits put in place by Dodd-Frank make it harder for one entity to hold a lot of future contracts. The goal of these boundaries is to stop the kind of market cornering that the Hunt brothers tried to do. Financial companies that deal with precious metals can get hedging exemptions, which let them take positions that are bigger than the normal limits for speculation. XC. The exact regulatory loophole that lets JP Morgan's 40% COMEX position get through is the hedging exemption. For now, if the CFTC decides that the position goes beyond what it allows for hedging reasons, the company will be forced to liquidate. And being forced to sell a 713 million ounce investment in a market that makes 835 million ounces a year would cause the worst short-term drop in price of silver since January, when it fell at 40%. Outcome 2, managed execution of the bullish trend. The purchase by JP Morgan of 750 million ounces of physical silver, the largest stockpile in history and equal to almost a year's worth of global mine production, puts the company in a position of unmatched market dominance. It can now create a supply squeeze that could drive prices to levels not seen since the Hunt brothers scandal in 1980. If JP Morgan's long position is not a corners play or a squeeze, but rather a patient physical inventory that it turns into cash through ETF inflows, lease rate income, and future appreciation, the result will be a multi-year silver bull run market, where the bank makes money at every point on the upside curve. It worked for 15 years to stop. Outcome 3, the turnaround of the feedback loop. It is said that trading teams at big banks like JP Morgan work together to keep the prices of precious metals low. To do this, they sell silver futures quickly when prices are rising. This stops rising and shakes out people who are long with borrowing money from they cover their shorts quickly when prices drop. Gold and silver, now JP Morgan has the same tools and it used on the short side for its 40% COMEX long position, but they are used backwards, buying too much when the market is weak. Strategic shipping needs to happen at the exact same time when registered inventory is under the most stress. And the ability to lend silver from its vault inventory at high lease rates, 8 to 12% right now, compared to a historical average of 310 to 510 of 1%, which lets it make money on metal. It doesn't have to sell. That was the CFTC's action on December 22nd that put an end to JP Morgan's practice of manipulating the market, just as its new long position was being set up. The U.S. Judge Franklin Aldermama of the Northern District of Illinois settled the CFTC claims against Michael Knoll and Greg Smith, two former precious metal traders at JP Morgan. This ended one of the longest running spoofing cases involved Wall Street's metal desks. More than 6 years after the lawsuit was first filed, according to the court order, Smith agreed to pay a civil fine of $200,000. This is not allowed to do fraud or anything else that is against Section 4, CA 5, or C of the Commodities Exchange Act ever again. Both men can't go back to jobs that are regulated by the CFTC because they are permanently banned from spoofing and from dealing with registering. The CFTC's final decision against JP Morgan's precious metal sellers came down on December 22nd, making the people who ran the operation forever banned from the CFTC regulated market after 14 days on January 7th, 2026. The CME Group daily delivered reports showed that JP Morgan had sent out 99% of the silver delivery notes for that session. The part of the case that showed how the trickery happened ended on December 22nd. By January, the physical accumulation phase that the formal closure made possible was already fully underway. 7, the most important institutional signal in the whole JP Morgan silver story is that the date and order. Since 2008 financial crisis, the CFTC regulatory powers has grown a lot. Better surveillance systems now watch trade patterns in real time. And the mark strange order sequences so that they can be looked at into spoofing, layering methods are automatically found by machine learning algorithms. A system set up by the CFTC to catch a repeat of the spoofing operations from 2008 to 2016 is now keeping an eye on the market, where the institution that the CFTC just forever banned two people from has changed from the dominant short to the dominant long. The person in charge who closed the old story is now watching the new story and watching the new start. The next part of this market will depend on the specific question of whether the next chapter needs its own enforcement action or whether JP Morgan's long position is just a legal business. Repositioning of a bank that knows silver structural fundamentals better than any other institution on earth. 8 big banks systematically messed with the rare metals market. 8 banks were fined. Total of $1.27 billion by the government for the 2008 to 2016 spoofing. This is a very different market structure than any other one the spoofing desk has worked in. Market pulse, different, design at its core. That is the most important sentence in this whole JP Morgan silver story. And it came from a same study that showed how the manipulation happened over and over again. The spoofing operation happened when there was too much silver on the market, not enough industrial demand, not enough deficit pressure, and speculation driven prices the most. The market has had structural deficit for 6 years in a row with a unrealistic industrial demand using 60% of supply. A registered COMEX vault with a 14.4% coverage ratio and state accumulation in gold buying countries like China, Russia. At that time, the manipulation worked because the structural story was not strong enough to stop the creation of the paper supply, which kept prices low. The story of how 2026 was put together is not weak. JP Morgan's short position kept the paper ceiling in place for 15 years, but it wasn't really a ceiling because the bank had the power to stop endless structural demand. It was a ceiling because the demand wasn't strong enough yet to go over the supply of paper. The balance has changed. Also, JP Morgan, which knows more than any other company about how this market works, changed its position for short to long exactly when it thought the structural demand was high enough to beat any paper cap. Now keep an eye on the CFTC Bank Participation Report, which is posted every month at cftc.gov, for the first sign that private banks are reducing their positions in silver futures. Keep an eye on the daily deliveries notices from the CME group to see if JP Morgan keeps releasing at 99% rate in future delivery cycles. Keep an eye on the SLV to see if the custodial connection changes. The SEC Edgar report shows that the JP Morgan is in charge of keeping silver safe for this creation and conflicts of interest that regulators will look into if silver volatility goes back to where it was in January. Also keep an eye on the CFTC's statement about position limits. Any new measure taken against the concentration of precious metals is what sets off an outcome. You can check every number, the CFTC agreement on the cftc.gov, the law December 22nd filed from the federal court, the delivery data of January 7th, cmegroup.com, every delivery notice, the guess of 713 million ounces of the CFTC's bank participation reports. The Edgar SLV files were linked to each other. At 2 a.m., JP Morgan controls the silver market, but not as the short seller. That pushes down the price of 15 years, instead as a longest estimated physical holder in history. With 3 possible outcomes and the market structure story stronger than any other time during the manipulation era, it's not possible to say what will happen next. It's the known outcome of the biggest shift in institutional positions in the history of commodity markets. It's happening in the market where the real world and the paper world have never been more different. This is not advice or signals. It is financial warfare. Thank you for stopping in, and try to have a great rest of your day.